Hey everyone. Today we have another great episode here for you at Investors Therapy. My friend Chip joins me. He's a former Google engineer. He used to work in the Geo team. He has an amazing story. We talk about the Great Depression and how his family got through it, his family's early investments in farms, what he learned from his father, who had a real estate brokerage business, how he got invested in stock, how he managed real estate investing while working a full-time job, how he got into commercial real estate. Then we go into retirement and all other great stuff. This is such a big episode that we got to do 2 episodes. So we're going to do part 1, which goes into commercial real estate, and then part 2 is going to go into his life pre and post retirement, and I'll be sharing that later. Hey everyone, welcome to Investors Therapy. I'd like to introduce you to my friend Chip Chapin. He was a former engineer at Google, worked in the geo space, and he has a fantastic career. So we want to talk about his career and how he got involved in investing. So Chip, thank you for joining us.
Thanks a lot, Jordan. I loved all the meetings and things you did while we were there at Google, the real estate investors meetings. It was always interesting. And most of all, I enjoyed the mail list that you and many of the rest of us participated on. Just a lot of fun, both for regular market investing and especially the real estate stuff, which I've always found very interesting.
Thanks, I appreciate that. And you contributed a lot too. You would bring in speakers and whatnot. You brought in some people from Colliers to talk about triple net leases, and it was awesome. So thank you for your contributions and always being so open to help the community. We really appreciate that.
Of course. Yeah.
So how about we start with, let's start with your career. I want to talk a little bit about just your background, your career, and then from there we can transition into investing and whatnot.
Definitely. Yeah, that sounds fine. So as you've already pointed out, my professional career was as a software developer, and I've just retired. So I started in the 1970s back at UC San Diego. It was really the dawn of the personal computer era. So I actually started out programming personal computers. At UCSD, we developed what proved to be a very popular personal computer operating system, known variously as UCSD Pascal, because it was Pascal-based, which is a programming language, of course, or a UCSD-P system. Anyway, it was an early fixture on a lot of personal computers, and it really helped me get a start in the business in a pretty big way, as opposed to just going out and working somewhere. So I've done a lot of things. I have worked at startups. I worked for a leading personal computer software company and a couple of really large companies, notably Hewlett Packard. I worked there for about 12 years, starting in 1985. And then 14 years at Google, starting in 2005, which is where I've just retired from. Interestingly, about half my career has been as a software manager, and the other half has been as an individual contributor, and actually kind of inverted. Mostly the first half of my career was I was mostly managing, and then towards the latter half, I've really wanted to get my hands dirty and do more programming. So that's what I've been doing, really since about 1999 or so. Okay, so a couple things about my career. I was just thinking about it since Jordan, you kindly prompted me to talk about it. I was thinking about this some. Now, twice during my career, I've actually gone out on my own and started a small business in software development. Neither one, I would say, was financially successful in the sense that I couldn't support myself with it, but they were successful in a lot of other ways. And it's interesting to look back on it. Of course, at that age, what we're really trying to do is put bread on the table, buy a house or whatever, and money is really important. But definitely the experience was worthwhile. Both businesses were profitable. I didn't lose anybody else's money in the process, so at least there's that. On the investing side, do you want me to go ahead and get into
so
the investing side?
What's really interesting is, I assume that when you were working your career, you probably had a 401k and you did saving there, and so you did that standard saving. And then you probably ventured out into private equity, as I like to call it. So basically, private
Yeah.
equity, which is my term of using it is it's your ability to invest either your time or money into the real economy to earn cash or equity. So can we go into your private equity investing?
Yeah, absolutely.
Mm-hmm.
Uh, I can talk about, I think, let me start by talking a little bit about how I got exposed to real estate. And I'll
Mm-hmm.
also talk about stocks a little bit
Right.
in a minute. Now, my father was a real estate broker. So I was exposed to that side of it from an early age. We were in a small town in North San Diego County called Rancho Santa Fe. And real estate was my dad's business from 1948 until he retired in the 1970s. And not just him, but it turns out his parents and my mother's parents had done a lot in real estate. But both families lost heavily in the crash of 1929 and the Great Depression, and really didn't come out of it owning much of any real estate at all.
Can we jump
So,
into that real quick? Because I think
yeah,
they
absolutely.
lost money in stock and real estate, and
Stock and real
and
estate,
and
yeah.
back then that was like before the 30-year fixed mortgages and things like that, right? So it was a much different
That,
market than we have now.
yeah, it was a lot different, and I'm no expert
Hmm.
on some of the fine points. I don't know what kind of financing they had in place. I know that for the real estate, the key thing was if you have commercial real estate, especially if your tenant goes broke, then they're not paying rent, and if they're not paying rent, you're not getting any income from the property. So uh, if you have debt on the property, of course, you have to be able to service the debt. If you can't, it's foreclosed. Or it may just, maybe you don't have debt, but you're living on the income,
Hmm.
or you're relying on the income in some other way. Um, you still can feel the pinch and feel that you need to sell. And of course, in a situation like that, asset prices are depressed. You can wind up selling at the bottom of the market, which is I mean, the market is the market. It is what it is. But when you sell and don't buy a corresponding asset, then you're just basically consuming your muscle mass. And I think that's what happened to a lot of people. That's certainly uh, as a small child, literally sitting on my father's knee. These were the kinds of stories that I was exposed to early on.
Amazing. It's amazing to have that type of experiences and learn from your family. So
Well, it was
yeah.
good to learn from, and I would just add that even even much later, let's say in the 1950s and 60s, my dad's own real estate business, which was successful, and I don't recall him ever having a particularly bad deal, a deal that went south on him. Uh, but we could still see things going up and down. It was always a boom and bust cycle, which is traditional in California real estate, you might say. Um, and so it was kind of drilled into me. We could see things happening around us where maybe somebody would start a project, they'd be going along with it, and then they'd run out of money, as the saying goes, and the project would just sit there half completed. And we've had lots of examples of that just around us, especially after our own Great Recession of about 10 years ago. A lot of projects sitting there incomplete, maybe rebar sticking out, or maybe just a vacant field. That can always happen. One of the things I realized from all that was that if you're speculating in real estate, or really in anything, but in real estate especially, you either have to be very nimble so that you can get in and get out. And since real estate's not always very liquid, that can be hard. Or you just need deep enough pockets to hunker down and ride it out. There's actually another approach, which is not something uh, either my dad or myself ever did, and that's really invest with other people's money. Um, if you do that, there are a lot of advantages. One of the advantages, or you could look at it as potentially a disadvantage, is that if you go bust, you're losing their money and not yours. And while from a strict survival standpoint, that's certainly better, I know that people who do syndications don't like to lose anybody's money. If they're a good, honest operator, and they're gonna feel the pain just as hard as if it was their own. Usually, they are losing their own as well. But that is another way to mitigate the risk. Is instead of diversifying across multiple assets, you can also diversify the sources of funds and have other people share the risk with you.
That's a great point. And
Yeah.
going back to your father, so he ran the brokerage company, and so he was
Yes.
closing transactions there, so developing cash, and then would he use that cash and then go buy more real estate?
So he was there are multiple aspects of the business.
Hmm.
Yeah, that's a good question. So he was a retail broker,
Hmm.
retail residential broker, and he'd have people wandering into the office, and he or his agents would sell them a home, and he'd collect the commission, the standard 6%, just as today, although it's often less than that today. But then, as many brokers do, he's also involved in deals on the side. So, for example, he would participate in syndications or lead a syndication. Now that I think of it, I remember at least a couple of land deals that he did in that area. I'd actually forgotten about that.
Would he put his
Um,
because he probably, I mean, did he find the land and then would he put his commission into the deal as part of equity or how?
those are great questions.
Yeah,
I'm afraid
yeah,
I don't know the details.
gotcha.
Uh, I'd actually just be guessing.
Yeah.
I'm yeah, I really don't know. That's a good question. I wish I did know. Um, no, there'd be those. And then at one point, he and a partner built a small apartment building.
Hmm.
The the apartment building is one reason why I don't do apartment investing.
Oh, really?
I really have nothing against the concept of investing in apartments, but it was not a great experience. He didn't lose money on it. It's just that dealing with tenants that you're on a first name basis with, because it was a small town, can be difficult. It's hard to raise rents if you're aware of problems in their personal situation. Maybe these are people on fixed incomes, uh, and one result of that is that you don't get the kind of return on the asset that you'd like to see. And if an asset lags in returns compared to what you could get somewhere else, then the tendency is to want to get rid of it, which eventually we did. And I heard him, you know, from time to time, he'd be saying, gee, so and so can't afford a rent increase, so I'm going to leave her rent alone for another year. And then he'd get the calls, when the sink's backed up and stuff like that. Now, I understand if you have a professional property manager, you don't have to deal with a lot of these things. But
It,
it made an impression on me, and I've tended to prefer commercial real estate.
it creates with the property management creates a degree of separation. I remember the
True.
first property I invested in. The gentleman who lived in the property since like the 19, I think like 70s or so, and he's been in the communities for a long time. He remembers like certain areas that people of color could not go into in Sacramento. And when I got the property, he was like 80 some odd years old, and I got the property, the duplex, at a very good price. But what he was concerned about was I was going to come in and jack up his rents. He was petrified,
Yeah.
and good. I mean, and reasonably so. That's usually what does happen. But I had to sit down with him multiple times and tell him like, you need to let me know when things need to get repaired so I can fix them. I am not going to raise your rent. And I spoke to him like 3 times, and I also had to speak to his family members until he'd feel comfortable enough to take care of me. But I, like your father, I felt that if I was going to, I was cash flowing the property, but if I was going to increase the price of the property on a gentleman who's on a fixed income, it just didn't seem right to me, especially for what he did for the community. And he also was a veteran. So
Yeah.
there's that social component of being a real estate investor that you got to think about. It's like not only are you here to make money, but you also want to be good and fair to people. So so that inspired you then, like, okay, I'm not going to do the multifamily thing. I'm going to get into maybe triple net leases or whatnot. Let's talk about where you got started.
Well, so I'll back up a little
Yeah.
bit. Um, I bought my first home in 1979, and a few years later, when I moved out of town, I rented it out. And of course, this is the way I think a lot of uh, regular folks get started in investing in rental property. You own something, you move out of it, and then you rent it out. Um, it actually went okay, but the thing is, it just wasn't really a money maker. It was the sort of thing you wind up just barely covering your mortgage and your fixed expenses on the property, um, maybe with a little bit. And so you're hoping the property is going to appreciate in value. And at that time, in the early to mid 1980s, uh, prices, at least in that part of San Diego, which is a very nice part, just weren't increasing very fast. So uh, it didn't leave me feeling like this was a huge success, even though my tenants were great. They took care of everything. They never bothered me. They were like the world's greatest tenants, but it still didn't leave me thinking, gee, this is a great business to be in. So that was my first experience.
Mhm.
However, if that wasn't enough, later, in about I guess 2006, I bought a rental condo up here in the Bay Area, and I bought it with the express purpose of renting it out. And so I'm thinking, okay, this is going to be a good business. I just need to try it again, and it's going to be great. Well, this was, roughly 2006, maybe even 2007 when I closed, and of course, prices plunged a year or two later, and stayed down for a while. And rents were okay on it, but once again, it's not really a moneymaker. And if I'm not making anything on the appreciation, instead I'm losing on it. It just didn't leave me thinking this is a great investing strategy. So without going into too much detail, that was the last of my residential rental
And did you
efforts.
sell it or did you hold on to it? Sorry.
I did sell it,
Mhm.
and actually, I misspoke. It wasn't the last of my residential efforts. Um, I sold it, and for various personal reasons, I wound up owning a different condo, uh, which I actually bought at about the same time. So even though I sold this first rental condo for a significant loss, I think I bought it for in the neighborhood of 450, and I sold it for just over 300. So it was a pretty significant loss.
Mhm.
Um, but then I bought this other property uh, for a price in the 300s, and it's now gone up, you know, quite a bit more than double that. So it worked
It's
out,
kind
and
of
I think this is
a rough wash. And
yeah,
then you got, for taxation purposes, you bought 450, sold at lower price. So did you get some write-offs from that?
yeah. I took the write off on it,
Okay.
and it's the sort of thing you have to look carefully at. But the write off was useful to me in the year I took it, and so I actually felt pretty good about that. And that is the one thing about losing money that mitigates the bad feeling you get, is that if you do it right, it gives you a nice tax deduction.
Right.
So
And
making money
you're
from it.
dropping a lot of pearls of wisdom. So I want to jump back on a few things. For
Okay.
someone who's new to real estate, let's talk about, and you're not a CPA, of course, disclaimer, but let's talk
Yeah.
about how that write-off process works. So you bought it at this price, you sold at a lower price, now you have a loss.
Yeah.
How does that play with your taxes, and how could that be beneficial?
Well, okay. It's interesting. And again, I'm not a
Mhm.
CPA. I tend to learn these things when I need to learn them, and then forget them. Uh, okay. So first of all, as probably most people listening to this know, um, if you have rental property, it's often generating passive operating losses, and your passive operating losses, unless you're real estate professional, which probably very few of us are filing as, uh, then they just accumulate. You don't get to write them off. Um, when you sell a property, even even if you didn't lose money on a capital basis. So if I bought it for, let's say, 450 and I sold it for 450, it's a wash from that standpoint, but you've probably got accumulated operating losses. And when you sell it, you can realize those
And operating
losses.
losses are like paying for tax. Would it be like
Yeah. Well,
maintenance and things like that? Or
yeah, yeah. So let's say let's just take a simple residential property. You get rent. That's your
Mhm.
income. Your expenses are going to be your taxes, your insurance, possibly association fees, maybe maintenance, anything anything associated with owning the property. Even, for example, your mileage expense and going there to inspect it. These are all things you write off against the income. And unless you paid all cash for the property or have owned it for a long time, uh, you're probably going to have an operating loss. Now, there's also depreciation, which is a huge thing. You're going to be writing off the property. I won't go into all
right.
nuances of depreciation, but this is also contributing to your operating loss. Then, when you sell the property, you can uh, take that loss and apply it against regular income, as I recall.
Okay.
Um, the other thing, the capital loss, is a little different, and I'm just trying to remember the particulars of it. I think it's just a regular long-term loss, and you can write it off against other capital losses, just as if you had sold stock and had a loss on it. I
Okay.
don't think there's anything more to it than that. But again, I'm not a CPA,
Right.
and
Well,
this was a few
disclaimer, don't worry, no one's going to sue you. We're all good.
years ago.
So let's talk about you keep on mentioning the point of so you at one point you're the software company, then you manage
Yeah,
engineers, you're making good money in tech, then you're doing real estate and you're seeing, well, wait a minute, for every hour I invest in my job, I'm getting equity, I'm getting paid well. I put now in real estate and the returns aren't as good. So it looks like you have like a kind of you're looking at the comparable, like the value of your time compared to box A and box B. So
yeah.
after
The returns of my time in tech were much greater than the returns I was getting in real estate up to that point. Um, there's some other things that changed, but I don't know if I'm leading the conversation astray too quickly.
no, just go
Did
for
you
it.
have more?
Yeah, go.
Yeah. So another thing lurking in the background here is that my family had owned a farm in the San Joaquin Delta between Tracy and Stockton, and this had been in the family for well over 100 years. So it's owned by multiple cousins. I think there are nearly 20 of us that own it, and we sold this property in 2014. Now I was there was a even though there's 20 cousins, there's about four of us who manage it, and I was one of those four.
What type of farm
One
is
of the
this?
things,
Is this like a dairy
it was like a
farm or
commercial farm. It was about 1,500 acres when we sold, and it grew commercial crops like wine grapes, blueberries, walnuts, alfalfa, and various other rotation crops. So it was a relatively big business. Um, Professionally run. We had a professional manager, staff of people. So it's not like I was out there driving a tractor.
I expected that from
We'll say.
you while doing engineering too.
Yeah, I would have liked to have done the tractor,
Yeah.
but although I did get to drive the blueberry harvester once, that
Oh,
was
that's
interesting.
awesome.
Yeah. So this was this whole business that we were selling. And since it had been in the family for so long, you can imagine our basis was quite low. Uh, so we're looking at big capital gains. Now, I had never done a 1031 exchange before, but I knew the concept. I knew what they were. I just didn't know how to do it. And looking at a property like that, and our share of it was relatively large. It was a property, I basically shared a portion of it with my sister. Um, And so I wanted to see, well, what can I do to save some tax money? And when you look at the amount of tax money I could save, it was quite a bit more than my annual salary. So it was worth spending some time to figure this out. And I actually wound up taking a leave of absence from work in order to focus on this. It just took so much of my time as I got into it. And we can talk about that more later because I know you're interested in the time trade-offs,
Hmm.
and this had a huge uh, the time conflict was substantial on this, and I kind of backed into it, not how much of a problem it was going to be. On the other hand, there was so much money at stake that it was worth it to me to take the time to figure it out. And I could go into details on how you get from a partnership interest to a 1031 exchange.
This is your show. Let's do it. I also have some other questions because I have a lot of Googlers or tech employees, Facebookers, Googlers, Amazoners who come to me and
Yeah.
say, "Hey, my family wants together, and we're just going to get together and buy property, and it's going to work out fantastic because we all love each other." Can you talk about that aspect of you're in this gigantic farm investment with like 20 other of your cousins, like
Oh yeah,
feelings and
yeah. So
personalities and different goals and interests? Like, were there some people who wanted to hold on forever and keep on getting? I assume this thing cash flowed. Was it making money?
in a good year, it made some good money.
Okay.
In many years, it made no money.
Okay.
Um, so it just really depended. I could talk about farming for a while, but that's probably not the main subject
Right.
per se. But from a family investment standpoint, so this was interesting. There's a lot of pluses in having an investment like this. My parents' generation, they were all first cousins, and or brother or siblings and first cousins. So they were all quite close, and they could work together extremely well. And they had a family dynamic that made everything run very smoothly. As we get down another generation, so myself and um, you my own sibling, my sister, uh, some of my first cousins, and then some relatives that are also cousins, just a little more distant. Um, we all get along well, but we have different motivations. You have this relatively big asset. You have members of the family that really don't have very big incomes and maybe hurting for money. And they're thinking, gee, we've got this big farm, but it's not paying out any money. What we really need is some money. And you've got other people who are making great money at their work. They may be professionals, or they may own a successful business, depending on who we're talking about. And to them, if the farm doesn't make much money, they really don't care. Even in a good year for them, maybe it's helpful, but it's not the biggest thing to them. So everybody different motivations. And one thing we did that was really good, we had an annual family meeting where everybody came together. In fact, some years we had two meetings where at least a subset of people would come together. And this is a good dynamic. Nevertheless, the problems are you have what amounts to an underperforming asset. You have people who want to do their estate planning, and they may have different objectives, different requirements in terms of what to do. And also, you get a kind of diffusion of energy as it goes down. So when my parents' generation were operating it, each of them was responsible for a quarter or a fifth of the ownership of the farm, and that's a pretty hefty chunk. And they're motivated to invest some effort into it. As it gets further down, you get people with a much smaller share, and their motivation for putting time and effort into this thing becomes just much smaller. They have lives, they don't want to be bothered with it. And I think as I look back on it, even when we did put time into it and understanding that this was a business that we had kind of grown up with, I realized that it needed even more attention than we were giving it. There are aspects of this business where it actually needed probably a member of the family on the ground there every week to make sure that things were running smoothly.
Mhm.
It is a business, and if you just have some guy say, "You're my manager, you're going to run this business for me, and we'll meet with you once in a while," you're not going to get the results you hope for.
Yeah. Yeah, I
Yeah.
want to jump in. I was reading a book called Sugar Barons. It was about the sugar plantations in the Caribbean. And the first Europeans who came over, like, came from nothing, and they worked really, really hard in the land, were able to just barely break even. And then their children might have taken over and took the business to the next level.
Oh yeah.
But then the children's children were over in Europe, and they're like, I'm not going to go to the Caribbean and handle all that stuff. I just want to just eat all the money that comes from the investment. So they're like, hey,
Right.
we'll just get our lawyers to take care of it. And then the plantation just like imploded. So
Yeah.
I have a question. The way that I'm assuming this property is put in a trust of some sort.
Yeah. Yeah. Okay.
Yeah.
This is an interesting
Yeah.
question. So the property was owned by a partnership, a
Mhm.
general partnership. This was set up in the days before LLCs, or it would have been an LLC, but it was a general partnership, not a limited partnership.
Mhm.
Um, and fortunately, we never had any liability issues, so that part really didn't matter. Um, the uh, the individual partners in some cases were trusts. So, for example, in my case, uh, there was a chunk of it that was owned directly by my mother, and then another chunk of it that she had put in a trust that uh, my sister and I, and we had a brother who's deceased, but the three of us had been the beneficiaries of that trust, and eventually the trustees. I'm a trustee of the trust now, and actually do all the management on it. So the structure gets a little complicated. Now, to anyone who's thinking of doing this, even if you use an LLC, the problem is a partnership interest or an LLC membership is not something you can exchange. So the IRS doesn't consider a partnership interest to be like kind with another partnership interest in another piece of real property, or even another piece of real property entirely. What you have to do is something that's often called a drop and swap. And that is you would drop the partnership interest to the individual partners as tenants in common.
Mhm.
So now you have a bunch of tenants in common of this asset. Now, a tenancy in common, your share is is considered, assuming it's real estate, is considered like kind with other real estate assets. So that's actually what we did. It was a lot of trouble.
Did it cause a
Uh,
taxable event, and how was it trouble?
well, the dropping to tenants in common is a big deal because now everybody has to sign on everything
Oh,
or almost everything. And if somebody doesn't want to go along, they can block an entire deal. Whereas if you have a partnership, you've got a, I mean, you have an operating agreement in either case, but the governance is
yeah,
different.
like the
The
operating
partnership,
partners who make the decisions, and then you have the kind of the silent partners, right?
exactly
Yeah.
right, exactly right. So with a partnership, you can have somebody who makes a decision and does it. When you have tenants in common, if cousin Sally decides she doesn't want to sell her 5% at the price you've negotiated, she doesn't have to do it.
Oh boy, she can
So
hold the whole deal up. So,
she can hold the whole deal up.
so you spend a lot of time in these family meetings saying, like, okay, everyone, if we're going to do this, we all have to agree this is what the next step will be. But was it kind of like a gentleman's agreement where you couldn't have anything like contractual obligations? It was more of let's.
I would say it was even less formal than that.
Okay.
The basic timeline was we had agreed to sell the property by this time.
Hmm.
I was meantime taking a crash course in the basics of 1031 exchange, and learning what is a drop and swap. Literally, weeks before we're signing our contract to
Well,
sell.
were you still on sabbatical, or were you still working your job while doing this?
I was still working my job at this point.
Easy
Uh,
task.
yeah, um, and I won't deny that my work suffered
Hmm.
during all this. It was quite stressful.
I could imagine.
Um, the so there wasn't as much foresight and planning that went into the drop to tenants in common as would be best. On the other hand, it still worked out pretty well, and I was able to do the exchange. I think at least one other of my cousins did an exchange. For most of the rest of them, it was just a wash. It worked out the same as if it had just been sold with their partnership
Okay.
interest.
So this you use this to jumpstart your other commercial endeavors. Let's get into that.
Yeah, yeah, exactly. You're exactly right. So now suddenly there's a much larger chunk of capital, and the requirements of the 1031 exchange. There's a certain timeline. Basically, you have to conclude a deal within 180 days. There's also a property identification period up front that can't remember if it's 45 or 90 days. I think it's 45, where you have to identify the property. So you have to move really, really fast. There's never enough time. And so I wanted to do commercial property. I wasn't sure what kind. I was basically taking a crash course in commercial real estate investing at the same time. Finally wound up doing 2 triple net deals. One of them was very simple. It's a triple net 7-Eleven.
What's a triple net, first of all?
Oh yeah.
Explain like I'm 5. Okay, like you talk,
Oh.
like everyone talks to me at Google, like I'm 5 years old. So just
well, Jordan.
I got sock puppets.
So yeah. So the term triple net is they're basically 3 nets. So net of taxes, net of insurance, and net of operating expenses. And what this essentially means for practical purposes is that the tenant either pays those expenses directly or reimburses you for them. And usually when people talk about triple net property, they're referring to a situation where the tenant is paying those expenses directly. Although it's often the case that it's very rare, I think, that the tenant pays the taxes directly. You can do it. The 7-Eleven deal, which we still own, 7-Eleven pays the property taxes directly, but that wasn't the default. We had to set it up that way. They're normally set up to reimburse you for the property taxes. So one was a 7-Eleven. The other was a single tenant in Morgan Hill, fairly nearby, with a preschool, fairly large preschool. And that deal was one where, for example, I paid the insurance and they reimbursed me for the insurance. So, and of course, I did the property taxes. So in that case, when I gave them a rent statement, there'd be their rent, and then there'd be the insurance reimbursement and the property tax reimbursement, just 2 items. And occasionally a repair reimbursement, depending on the repair.
That's beautiful. So how did you source these deals in the first place? And then how did you analyze them?
Yeah, good. Super good questions. They came from very different sources. I was trying to work as many aspects as I could in parallel to make this happen, because I knew I had a pretty big hole to fill. The 7-Eleven, we had sold the farm through Cushman and Wakefield, and our Cushman and Wakefield agent on the deal hooked me up to their triple net leasing folks, and they just basically tossed about 3 deals out and say, "Here, try these." And I looked at it, and that was the 7-Eleven deal, and wound up going forward with that. We should come back to the 7-Eleven deal because there are a few specific aspects of it that didn't go very well,
Right.
and that I would have done differently. So I think that's worth discussing. The other deal, I was working with a local brokerage here in San Jose, CSR Commercial Realty, that I really recommend. Really good people. And we were just sitting down together, meeting periodically. They would source deals using their contacts, and I'd be looking up things on LoopNet. And LoopNet, for anyone who doesn't know, is kind of the Zillow of commercial real estate. It's now owned by CoStar. CoStar is also a big provider of real estate data, but you have to subscribe, and CoStar subscriptions are quite expensive. Possibly worthwhile, which is a subject in itself, but I was using LoopNet anyway at this time. And I think the deal we found, it's one that they sourced. A developer in Monterey County who's done a lot of single tenant deals, strip malls, restaurants. I've forgotten their name. Actually, I have. It's Shaw Development. Had developed this property some years before. They owned it and had it leased out, and finally they had decided to cash it in. So it was a turnkey deal. It had a tenant, had the lease in place. It was cash flowing, and I can't remember off the top of my head. I think that was about a 6.5 cap rate.
Can you explain what a cap rate is, please?
Sure. Okay. Cap rate, very, very simply, short for capitalization rate, and it's intended to provide an indication of your return on overall capital. So very simply, you take the net operating income, which of course is the income after expenses for the property, and you divide it by the selling price of the property. So for example, if you're making $100,000 net operating income on a property that you just bought for $1 million, you have a cap rate of 10%. And probably, well, I don't know if we should talk about, what are typical cap rates, but
we shall. I'll just say it's your show. Let's do it.
So in the current market in California, or even in the market in 2014, a 6.5 cap rate was pretty good, but that's historically relatively low. Historically, people would probably want to see cap rates of 7 or 8, but valuations are compressed, especially in California, meaning the prices are high for what you get, and so cap rates are lower. The 7-Eleven I got into at a cap rate of just a little over 4, which is still about the typical cap rate for something like that, a 7-Eleven.
And I'm guessing it's a 4 because it's more of a stabler tenant.
Yeah, exactly. 7-Eleven is a I don't know, an AA rated corporation, depending on what system you use. Very, very stable, strong book, solid sales. Their business model seems stable. That said, you never know. There's no risk-free lunch.
Right.
But that relative lack of risk is reflected in the relatively low cap rate. You could think of it a lot as a bond. This is a bond, imagine, that pays a 4% coupon that actually rises periodically during the lease because your rent rises, in this case, 10% every 5 years. And then at the end of the bond, let's say it's 30 years, instead of just getting paid your principal back, one hopes you actually get paid back a whole bunch more than your principal, because after 30 years, you'd like to think that a well-located property in California is going to be worth a lot more than what it was when you bought it. So there's a lot of advantages to owning property like that. Some of the disadvantages are you're getting a relatively low return. So if you look at it just in terms of income, so 4%, you can get a 4% return in a lot of ways with probably less risk than this particular deal, and probably a lot less trouble. Another factor in this particular deal is that it's a ground lease. Now, a ground lease is where, let's say I own a piece of property, and Jordan, you want to build a auto repair shop on it, and you say, Chip, can I buy your property from you? And I say, no, I don't want to sell it, but I'll lease it to you. And so I lease the property to you for 30 years or 40 years, and you think that's going to be the lifetime of your building. And you go ahead and build the building. That way, you didn't have to put any capital into buying the land. All you had to do was pay me rent for that land. And at the end, I still get the land. In fact, I get the building that you built. So it can be pretty good.
God bless America.
the problem with a ground lease, though, that's not immediately apparent unless you've really thought about it, is that the owner of the ground has nothing to depreciate.
Mm-hmm.
They own a piece of land. The land is not depreciating. You put up a building, your building is depreciating, but the land is not. So, for example, if you finance the property, you're making interest payments. That's fine. The interest payments are going to be offset by the rent you're getting, but you might be also making principal payments. And if you look carefully at most finance deals and how the cash flow works out, you're making these principal payments, but you're also depreciating the property, and the depreciation is an expense, and which reduces your net operating income. Anyway, the long and the short of it is, after taxes, you don't feel the pain of that principal payment.
Mm-hmm.
If you don't have anything to depreciate, that principal payment is really coming right out of your end, your end of the deal, not your rear end. It's coming right out of your income, and you have nothing to mitigate it, no tax savings to mitigate the pain, so to speak. And what it really means is that financing a ground lease deal like that, the cash flow just doesn't look as good. You can still do it, the lender doesn't care, but if you look at the numbers after taxes, it's less attractive than if you can depreciate it. That's the basis of it.
It's a really good tip. And also, when I look at real estate investing, it becomes personal, where you look at how aggressive a strategy do you want to do. I tend to see people in the beginning of their careers, they're looking for aggressive appreciation, aggressive cap rates. And then you get to a point in your career where it's more about protecting your capital invested, but also being able to get a little bit of upside that's better than bonds. So it seemed like you were more in the capital preservation side of the equation.
Yeah, I think that's fair. And I think a good strategy is to preserve your capital and, of course, try to make it grow at least in line with inflation,
right?
While still getting a nice income from it. And I know one of the things you'd wanted to talk about, we haven't really gotten there yet, was financing retirement. And the key thing for financing retirement is income. You need income to live on because you're going to replace your salary. So, whether or not the property is going to have a fantastic capital gain in 30 years, that's important, but I still need income from the property. And that has really been a big factor in how I've chosen to invest these past few years. Within the last 10 years, certainly, is trying to think ahead. How am I going to replace the income from my salary, and not just making an investment that looks like it'll have a good capital gain on down the line.
That's a really good point, because we have a lot of index funds investing, a lot of 401k investing. So we're already depending upon appreciation, which is an important part of your portfolio. But let's say you retire out in the middle of the Depression, or you retire in the middle of the financial crisis. Are you now going to sell assets at a 50% discount so you can make ends meet? And I think a lot of investors do not want to do that. And so having a cash flow component of your portfolio is just really important to have. So
it's super important.
So when you were making the decision of looking at these triple net leases that these companies are sending you, like did you look at any like metrics or anything? Like what were like the important things that you looked at, like the kind of the 80-20 of the analysis?
Yeah, I looked at a lot of stuff. So I had a very elaborate spreadsheet actually that modeled that I made that modeled not just the basics of what the operating expenses were going to look like, but also the effect of appreciation going out. I think I went out 10 years or so. Maybe it was longer. It doesn't really matter. And then, even though I'd never really done this before, I was really modeling internal rate of return, uh, which again, I'm no expert on this, but internal rate of return allows you to try to compare apples to apples between investments, and it includes your eventual selling price in the calculation. So, and if you just think about it intuitively, let's say you have two 7-Elevens, and one of them is in Palo Alto, and one of them is, I don't know,
Sacramento?
Tracy.
Okay, Tracy.
Sacramento. Okay, yeah. Somewhere. I'm trying to think of somewhere even farther out there. Maybe out in Mojave. Mojave is a nice little town, but it's quite small. Okay, you can expect, and maybe their cash flow is the same. In fact, most likely you're even going to get a higher return from the one out in Mojave in terms of the cap rate, meaning you're getting more income per dollar invested. But what's going to happen, let's say 30 years down the line? Intuitively, most likely, and we don't know this for sure, the one in Palo Alto will have appreciated more than the one in Mojave. Why? Because the one in Mojave is surrounded by desert, and it is not a fast-growing community. Palo Alto and anywhere in the Bay Area is not surrounded by desert, and everything's very fast-growing, and there's a lot of demand. So if you really want to reflect the ultimate selling price, something like internal rate of return is the tool you use. That said, the things I've looked at more recently, I actually pay even less attention to IRR, and I don't think so much about the ultimate selling price. And one of the reasons is, for one thing, you're really guessing when you look that far ahead. You just don't know, and anything that takes recent history and just plots it out into the future is just a bad way of modeling stuff.
I'm sure
I'm
sure they're doing it during the financial crisis in 2006. They're just like, oh yeah, this is going to keep up for 10% per annum, and we'll be fine.
Well, that's what I did with that condo that I bought that I finally sold for a loss. I said, great, it's just going to keep appreciating.
Mm-hmm.
What's the problem here? And it didn't do that. So, and I could cite other examples of things where assets have totally tanked. So you also always have to consider that. So the last two properties I've bought, which we're probably getting a little short on time. Won't get into the whole history.
It's your show, Chip. I've told you multiple times. It's your show. Go for it. We got all the time you want.
Thanks, Jordan. I'll just say I've looked more on. First of all, I look at the property. I think, okay, is it likely to grow in value? Yes, because I don't want something that just doesn't have any potential. The classic phrase is you look for things that are in the path of progress, and it's a phrase that real estate investors have been using for generations. Path of progress. If you're in the path of progress, then you're probably looking good. Trying to model it much more precisely than that is probably a bad idea. So path of progress, and then I look at how's it cash flowing, and are there opportunities to improve the cash flow. So these other two properties, which we haven't touched on until now, are commercial centers in Las Vegas. And they're both, quote, neighborhood centers or strip centers. One of them really is a strip center. It's just all in linear. The other one's on a corner. It's kind of an L shape. So since it's an L shape, I don't like to call it a strip center. With retail, the nice thing about this type of retail is, first of all, you got built-in diversification as opposed to a single tenant deal. I mentioned the single tenant in Morgan Hill. I didn't like actually having that one tenant. For one thing, even though it was a multi-site preschool, they had multiple locations, they still they weren't a big company, and they were expanding rapidly, which meant they had a lot of demands on their cash. What this meant, as it affected me, was that they wound up not paying their rent on time.
Mm.
So that's always a hard thing. With the retail centers, you might have a tenant who gets into trouble and can't pay their rent. Well, but you still have the rest of the center going. So hopefully you're not so heavily leveraged up on the deal that one or two tenants are going to sink the deal. In fact, the most recent one I bought is about 25% vacant as I bought it. But even with that vacancy, I still have a positive cash flow.
Okay.
And once I get it fully leased up, it's going to work really, really well.
That's fantastic.
So
Let's go into how you're managing these. Do you have a property manager, or are you working with brokers to fill these vacancies?
yeah, that's a great question, and I kind of lucked into this. I won't say I lucked into it, but again, I'm learning as I go. The first one I bought, and this was when an exchange out of that preschool that I mentioned. So I said I want to sell that, so I sold it and exchanged into the center in Las Vegas. The center was up and running. It was 100% leased, and it had a property manager. And I kept the same property manager. I interviewed them. It's a pretty good-sized company in Las Vegas. Sun Property Management, great company. And I just kept them. So then I'm working with the property manager over the next year or 2 years. And I'm thinking, gosh, this person's great. This company is great. They're doing an outstanding job. So then when sometime later I started looking at the second center, the first question I asked was, I called my property manager and said, hey, take a look at this. Is this something you'd be willing to manage, to take on? Because I knew if they would manage it for me, it was going to work okay. If I had to find a new property manager, or if I had to do it myself, then that was going to be a red flag, and I wasn't going to do the deal. So for me, I was very fortunate to find a very good property manager early on. In a way, it wasn't complete luck, because you imagine the people who had been running that center previously, who had owned it, they do commercial real estate as a long-standing business, so they're not going to be using property managers that aren't any good. They've already vetted the people they have doing it. So I just took advantage of the work they had already done, and instead of making a gratuitous change, I just kept the incumbent. It's been great.
That's
So yeah,
fantastic.
property management all the way. For leasing, now the property manager usually won't do leasing in commercial. I'm not sure if that's a legal thing. It would probably be state by state anyway, but you've got your separate leasing agents who are really real estate brokers or real estate salespeople. Whereas the property manager in this case, that's like a specialty all its own, is just dealing with commercial tenants and keeping them happy, keeping the owners happy.
Excellent.
So leasing, I just to be clear, so I have a separate leasing agent on the second center,
okay.
Doing the leasing.
So I like the point you mentioned about property management, solid gold. We had Mike Fuller here at our Silicon Valley Investors Club meetup, and he talked about he used the same technique on the residential side. He will have his property manager actually go into neighborhoods or look at properties for him and scout them, and let him know if he would rent this out and for what price, which is huge, because some people try to just find a property themselves in a bad neighborhood and then go to a property manager and say, hey, will you rent this out? And they'll say, no, not in your life. Or they'll say, yeah, I'll do it, but I want a higher fee, and the rent that you assumed in your analysis is going to be much lower, which is terrible, terrible shock. So that was a really good
tip. That's golden. That's golden advice. That kind of professional insight into a deal can just save your butt again and again in so many ways. So yeah, fully agree with that.
So with the commercial leasing agents, is it similar to how if I was going to try to get, lease out an apartment, like would you sign an agreement with this commercial broker, and they would have the right to find a tenant and a right to get the commission if they place someone? How does that operate?
Yeah, that's exactly right. You wind up giving them, well, if you're selling your
Mhm.
house, you would normally sign an exclusive right to sell. Um, sorry,
Mhm.
and so that your agent has the exclusive right. Um, when you're leasing your property, it's the same thing. You would normally sign an exclusive right to lease, and then your agent can shop it around and and find a tenant. So it's the same kind of deal. You pay a commission. The commission, I guess it's kind of the same in residential. Um, the difference might be I don't know if in residential you have to pay the commission all up front. In commercial, the usual thing is you pay. Well, it's all negotiable, of
Mhm.
course, but you pay at least half the commission. What is it when basically when certain contingencies are removed, and the other half essentially when they're open for business. Or sometimes if it's a very long lease, then you might pay half of it a year down the line.
Okay.
But, but still, that's a big expense. If you look at a 10-year lease, the total value of that lease, and you're going to pay 5 or 6% of that within the first year, that's a big expense. So it's something to budget for.
So it comes out of your pocket first before you even receive most of those rents.
Yeah, absolutely true.
And then uh, now, when they find the tenant for you, the tenant might ask for negotiations on like you doing remodeling and other things like that. How is that handled? And does it come out of your
Yeah,
pocket?
that's a big factor. It does come out of your pocket, and you can essentially look at it this way. Um, if the tenant wants you to pay a bunch of money toward tenant improvements, or TIs as they're usually called, then you need to be sure you're getting a corresponding bump in the rent. So, or if they're not asking for any TIs, then you can expect the rent to be lower. And you can actually do the simple calculations of amortizing the cost of your TIs over the lifetime of the lease, and you could actually translate that into cents per square foot or dollars per month, and you can see the equivalence. Of course, it's a present value calculation because you're paying it all basically up front. You might choose to finance it. You might just, if you have the cash, you might pay it. It's a big factor, and it's something that I think, well, certainly some people wouldn't necessarily factor in. Uh, but what it really means is that if you have to do a lot of leasing activity when you buy a place, if you say, gee, it's got a bunch of vacancies, I know I need to lease it up, um, and I'm thinking it's going to take me this long. Okay, that's great. You do have to think about how long it's going to take you, but also think that in the course of leasing it up, you're going to have big expenses. You're going to have the lease commissions and the TIs. So, for instance, if you're putting together the financing for a deal, you have to take that into account because you're going to need that cash. Um, you're going to need that cash if you're raising money from investors. Really, the investors need to put that money in upfront because you don't want to have to go back to them and say, "Oh, hey, I forgot to ask you for this extra money." That's Nobody wants that. That's not going to fly. Or you can borrow it, which is a perfectly good way to go, but it definitely changes your return calculations. So it's just something you have to factor in right down the line.
Something I want to talk to you about is the concept of anchor stores. Now, here's you being an engineer, retired, you have experience in real estate, and let's say you have a big box company coming in and they're trying to negotiate a lease with you. Um, your agent sometimes has their short-term interest of closing a deal, so sometimes they're not really representing you in the best terms. How did you know that like you were negotiating a good lease deal? Did you bring a lease to other people and say, "Hey, am I getting hosed on this?" Or what? You
Yeah, that's a really good
know. Mhm.
question. Because we are right. We're just concluding the what I hope will be the new lease on the second center for a key position in the center. 'Center. Um, When I first started working with my agent on leasing it, we had some guidance as to what we thought it would lease for. We had the price it had leased for to the previous tenant. We had the price of my adjacent leases. And I had offers from two of the other tenants in the center to lease this other space at particular price. So those offers in particular kind of set my notion of what it was worth. What I learned was that those offers actually weren't very realistic. They maybe could have done them, but for a variety of reasons, I didn't want to lease it to the existing tenants. For one thing, that would have meant I had a tenant that occupied 50% of my center, and then if anything happens to them, you have a problem. And these aren't big businesses. These are little guys operating on a shoestring, and now I'm basically at their mercy, and that would be a bad thing. I got a pretty firm offer from a one outfit that wanted to lease it, and it included money for tenant improvements. And my first reaction was, God, that's way too much money. That's ridiculous. I don't have to pay that much. And not only that, they didn't. Their proposed rent was quite low, much lower than I expected. So I rejected that deal, and we didn't do it. But it at least gave me some insight into what people were talking about. So later, I got a interest from actually a much stronger tenant. So when they came at me with roughly the same amount of TI, I'd already heard that story. And so even though I didn't like it the first time I heard it, by now I'd discussed it more with my agent. I've discussed it with a few other people. I'd searched online, done different things. I'm thinking, okay, this amount of TI, actually a lot of it was just thinking about it. I had to think about it. This amount of TI is probably what the deal's going to take. And looking at it from their standpoint, for them, it's just a form of financing in a way.
Right.
So I'm thinking, okay, yeah, I can do that. But the rent has to be high enough to account for it. And I'll tell you, this other tenant, their initial offer, their rent price was the same as the first guy's offer, which was quite low. Well, we said no, and we countered at what we thought was fair. And we actually wound up going with that higher number because they were a little more sophisticated. They're not bottom feeders. And their agent understood the same calculus that we're talking about, which is, okay, if you want TIs, you have to pay for it. And so now we're going in with a much more competitive rent. The TIs are worthwhile because the space needs total rehabilitation. Worst case really is that they build it out, I pay the TIs, and then they fail. But I will at least have a fully remodeled space, and so I would get something out of it.
Excellent.
Even though it wouldn't be my first choice.
So can we talk more about the tenant improvements and like typically, like can you finance those or whatnot? What are the expectations of you as a landlord when it pertains to those tenant improvements?
Yeah, good questions. And again, I'm really still a novice in this part of the picture, but then that's how we all start with anything. So, for example, in this particular thing, I think I'm going to be paying about $40 a square foot, which in a space that's over 3,000 square feet, that's going to be quite a bit of money. So you really have to plan ahead for that. I've already spoken with my banker who holds the first mortgage on the property about whether they would finance that. I don't have to finance it, but I don't like having to put additional capital into a deal. And there's not enough cash reserve to cover that plus the leasing commission and various other things. So one way, let's assume for the moment I want to finance it. So my first mortgage lender, actually, which is a credit union, actually is interested. It's not the sort of thing they usually do, but I'm a good enough customer that they're willing to look into that, and they apparently have enough flexibility that that's a possibility. And if they don't do it, it would just be something I'd have to shop around. I don't know beyond that. Probably a lot of your listeners might know more about that particular thing, but that's about all I know on the TIs, as we say, tenant improvements.
Makes sense. So going into just investing in general, what are some emotional traps, like I could call them investment demons? Uh, do you think that negatively impact people when they're trying to make real estate investments?
Yeah, there's so many. And I think the same emotional traps apply to stock investments as well, or many of the same ones. There, there are a few. One of them is going to be, and I know there's a whole set of behavioral of names for these behavioral traps, but I don't have it in front of me. But one of them, I think it's called the sunk cost fallacy, or something like that, which is if you've put a bunch of money into something, you're reluctant to walk away from it because you're afraid of losing that money. So you could wind up putting more money into it, even if it's a losing deal. Um, that's certainly a factor in real estate. Um, I'd have to say I've been fortunate not to have anything exactly like that in my experience, but it's certainly the sort of thing we've seen where people put money into stuff that's just not working out for them. Um, Another, some more immediate things. I'm just thinking about some of my stock market investing experiences, um, and one of those is the recognition that valuations actually can go to zero. I remember in um, in 1970. So I was 16 years old then, not quite 17, and uh, we had some shares in Penn Central Railroad, and I think there's something that my dad had inherited, but I'm not sure. And so the basis was very low in these shares, and big railroad, 150 years old or whatever, 100 years old anyway. You expect it to be around. Well, in 1970, Penn Central went bankrupt. And I remember my dad showing me physical stock certificates that he had for Penn Central and pointing out to me that, okay, these now have lost all their value. And I don't know how big of a position it was for the family. I don't think it was huge, um, but it was enough that it made a big impression on me. So this idea that hey, you can always hang in there with something is not quite true. And another example of kind of the same thing that I was thinking of happened to me. Uh, we had invested in my dad had invested in a small local savings and loan, just a one branch savings and loan that started up in our hometown back in, like 1978. And it got acquired, and the valuation grew. Um, and after my dad passed away, I'm managing this particular holding. It's and I figured it out. We had a basis in these, an adjusted basis of about $1 in these shares, and this was a stock that was trading in the mid 40s through most of the early 2000s until 2007. And you may have heard of the savings and loan crisis. And the stock I had some notes here. Uh, the stock opened 2000 at 45 and closed the year at $13.60 in 2007. So keep in mind, I'm busy doing my engineering at that time. I've been at Google by then 2 years, and it's a lot of work, and I'm really focusing on my job. So I'm not paying a lot of attention to this. This is a very strong savings and loan. Um, good business. The business hasn't changed as far as I can tell. Great dividend. So I'm thinking we'll stay the course. It went down, but it'll come back. I don't want to be selling my assets at the bottom of the market, right? Because that's also a trap that you can get into. So I'm staying the course. Well, that's the end of 2007. It's at 1360. Oh, also keep in mind, I still have a huge profit in it because my basis is $1. And if I sell it, I'm going to realize all these gains. My goal was to hang on to it basically forever and just enjoy the dividend. And at some point, the kids get it. Well, in June 2008, it's at 6. And in August, it's at 4. Now, even at 4, keep in mind, I have a 300% gain because my basis is 1. But what I didn't foresee was that in September, it would go bankrupt. And Washington Mutual at that point was now worth literally pennies. I think it was 9 cents at the one date I checked in October. I wound up selling it in 2011. I hung on to it because once it's worth so little, it's like, well, geez, what's the worst that can happen?
Right.
I could lose a few bucks here, but maybe it'll come back. I sold it for 4 cents on a share in 2011. So my point in bringing this up once again is that things can go to zero, but the other is pay attention. If I'd been paying more attention, number one, I would have seen this happening, and then the third thing is really keep your emotions in check, because I can still feel how I would have felt about this, which is, oh my God, I don't want to realize this capital gain. Well, okay, now I'm letting the tail wag the dog. I don't want to realize the gain, so I'm not going to follow some good trading rules. And we haven't really gotten into trading rules for stocks, but everybody should try to think of some parameters that they're going to live by. One of them is if you have a stock and it drops a lot, that you may just want to sell it because it's going to take a long time coming back. Usually that means you can realize a loss. In this case, it would have been a gain, but it's just a bad sign. Now, some stocks dropped a lot and then came back. But if you look at things that were going on in 2007, 2008, most of them didn't lose like 60, 80%. Some maybe did and have survived and gone on, but this one didn't, and it was kind of a bitter lesson. Pay attention, and don't be afraid to walk away from it. Cut your losses. So I guess I kind of wandered off the topic of behavioral fallacies, but there's certainly a lot of behavioral baggage in that particular thing. I've had it for a long time. Oh, it's this company. It has its roots in this little investment that my father made. It's the family jewel here. Oh, it's a token of this great success because it was a brilliant investment in 1978. And now I've inherited it from my father. I need to hang on to it and care for it, nurture it, and over time it's going to grow again. No, I would have been much better off being dispassionate about that particular thing and just selling it, because anything like that starts exacting an emotional toll on you. Sometimes it's better to just get it off the books so you don't have to think about it. Clear your head and go on to something else.
That was perfect. That was great. That was great advice. I couldn't. That was a perfect answer. And I think the emotional toll that you talk about, we always focus on things in financial terms, but we forget the emotional aspects and also the time aspects involved of us just being a happier person or doing something more productive. So
that's true.
I try to keep an investment journal. Like when I make a position in a stock or I buy something, I write down, okay, what are the assumptions of why I'm buying this or holding this thing? And what would have to change in order for me to exit this position? So
yes,
this year's been kind of brutal for certain tech companies. And what I usually tell my friends is like, okay, so if you're looking at their business model, what in their business model has fundamentally changed that is making this not a good business going forward? And how much of this is just psychological overreaction from the market? If this is a fundamental business change that's going to ruin the business, then yes, get out. But if this is just a market overreacting, hold on and see yourself through it. Uh,
The investing journal is absolutely the best piece of advice
mhm.
for stock investing that I can think of. Um, just in your mind, you have an idea. Oh, I think I'd like to buy shares of XYZ, and you just have this feeling. Oh, I want to buy it, and you may have some reasons, but they're kind of vague. As soon as you start writing them down, they become crystallized. And a lot of times for me, when I write down my reasons for, oh, I want to buy this stock, as I write them down, I go, gee, that's not really very compelling. Or, oh, I didn't think of this other aspect. I'd better research this thing. And I often change my mind. But also true, a month later when the stock's not doing very well, and I'm thinking, God, why did I buy this thing? I can go back and look, oh, this is why I bought it.
Mhm.
And it's just like you said, then you can say, well, did it change? Did my reasons for buying it change? Or if it was a pure speculation based on stock price, maybe it didn't meet my expectations. Maybe it did something different, and that might be a reason to sell. But yeah, just writing it down, keeping track. It's a way of diffusing the emotion. It's a way of thinking clearly. Yeah, notebook, man, all the way. It's the way to go.
Right. And it's also a good way to reflect, because what you want to focus more on is the process of making a decision, not just the outcomes of the decision. Because you could have just went like, oh, I'm buying this company because it's a full moon right now. I'm going to do it. And then the company just takes off. And then you might start thinking, okay, I'm going to start doing full moon investing. But what it could just turn out to be is that you're lucky, or you can make the right analysis and it just turns out the company went the other way. But at least you can
Yeah,
focus
it's
on
totally true.
your thought patterns and how you can improve those so you can be a better investor.
Yeah, writing is the easiest way,
Mhm.
I think, to foster that. Yeah, I couldn't agree more.
Hey everyone, I hope you enjoyed that episode. If you did, please hit the like button and please subscribe and share it. If you are a current or former tech employee and you want to join the Silicon Valley Investors Club, please head over to svinvestorsclub.com. If you want to subscribe to the monthly Investors Therapy newsletter, please head over to investorstherapy.co and you can subscribe there. Have a great day. Thank you.